Okay, guys, so we've just had a look at the key drivers that affect the value of a nation's currency. We've understood how commodity prices for commodity linked currencies are massively impacting how they trade in the markets. And of course, for non commodity currencies, we've seen how interest rates have a massive impact because of the differential in interest rates between two countries, make trading and exchange rate very profitable when you're buying one currency with a higher interest rate and there's another currency with a lower interest rate. And it's the expectations for interest rate changes which are going to drive currency moves in the forex markets. So in this next video, guys, what you want to pay attention to now is, well, how do we analyze inflation to get an idea as to what's likely to happen with interest rates? Because as you've seen, interest rates are the key driver for all currencies on the trade in the forex markets. And then on top of that, as I was saying, for the commodity currencies, we have to watch the commodity price as well. But interest rates are the major driver that's going to attract money into a country, or it's going to make money go away from that country if the interest rates are going lower from a previously higher base. So what we're going to do now, we need to look at, for an example, how do we predict inflation and interest rate changes? Is if we can predict that, then we know where the money is going to flow in exchange rates, and we can get into good trades and make a really healthy profit when the market starts to shift based on their inflation expectations and interest rate expectations from the nation's central bank. So investors are using economic indicators as a roadmap to measure the strength of a nation's economy. And this helps investors understand the likelihood of inflationary conditions, so growth in the economy, or deflationary conditions when they have contractions within the economy, and the appropriate monetary policy response that will be set by a nation's central bank using interest rates. So what the markets are basically doing, guys, they look at economic data to get an idea as to whether an economy is expected to go through high levels of growth driven by strong levels of employment, and that's going to lead to high levels of spending, and the demand for goods and services are going to be going higher, and therefore inflation expectations start to rise. And then if the inflation expectations are rising beyond the central bank's 2% target, for an example, then the market's expectations for interest rate changes start to rise, and then we start to see the currency strengthen because markets are trying to get into the currency now so they can catch the move as the currency appreciates, say maybe 5-10%, and then get paid that differential in interest rates, which I was showing you guys on the spreadsheet. So there's three types of economic indicators that markets look at. Well, let's say economic indicators. I'm basically saying economic data. There are leading economic indicators, which these are economic data that is released and it's basically predicting what's going to happen in the economy. So that's the ones we need to always be paying attention to, is what is the prediction from this economic data that's coming out, so we can get an idea as to the economy going through growth and inflation or contraction and deflation, because then we know if there's inflation, we could get interest rate hikes. So that if interest rates are going up, that makes the currency more attractive and valuable, and that currency gets bought in the markets. Or if there's deflation and it's going away from the central bank's target, then we know the central bank may cut interest rates to try to stimulate growth, and buying, for an example, for goods or services, help drive up employment, but that makes the currency less attractive because, as you've looked at, that means that that currency doesn't pay as good up at interest rate as maybe it did before if they're cutting interest rates. So that's called leading economic indicators that predict this expectation. So that's what we need to pay attention to all the time. And then there's coincident economic indicators, which is basically just the economic data of the economy right now. So what's happening now? And the main economic indicators for data that's telling you what's happening now is inflation, or CPI inflation, or producer price inflation, which is basically the prices of the consumers are seeing changes month for month. So is prices going up or lower for inflation? Are producing businesses seeing inflation in their costs of producing goods going higher or lower? And is employment going higher or lower? So basically that feeds into the whole situation of businesses going for inflation. For strong employment, that just leads on to strong inflation. Or if there's lower levels of employment, that obviously affects the coincident economic indicators, which is inflation. And then we have lagging economic indicators, and that's basically just the policy responses set by the government and a central bank. So, for an example, a government may cut taxes to get people to spend more money. That could be inflationary, or they could raise taxes to try to slow down spending, for an example, if they wanted to. So, leading economic indicators are used by central banks, governments, and investors to predict the performance of an economy, to forecast how the economy is expected to perform over the next 12 months. Leading economic indicators are the main source of data we must pay close attention to so we can understand the direction of growth and inflation in the economy. Once we have an overall snapshot of how an economy is expected to perform, we can then, therefore, guys, start to predict the appropriate policy response that will be set by the nation's central bank and the government. And obviously, this policy response will be a key driver for the demand of the currency in the exchange rates. So as I was saying, if there's low growth / inflation expectations, so if inflation is expected to be dropping, we know the currency is going to be weak because of lower interest rate expectations. If there is high growth and inflation expectations, we know that there will be a high demand for the currency because of high interest rate expectations. I wrote here equity demand, and that's basically stock markets. Because basically, if you have low growth expectation, investors don't want to be owning stocks in that country, and that obviously means that the currency is even in lesser demand as well. And obviously, that feeds into lower interest rate expectation, and that's why I wrote equity demand there. So I'm talking about the stock market here. So, leading economic indicators are made up of the following: business surveys and consumer surveys. They are the two main surveys that are going to give us some idea as to what's happening in the economy. So as I was showing you, this is like this is for my advanced course where I teach people how to look at an economy, and we're paying attention to the leading economic indicators here. And what we're always doing in this section here is trying to predict what's going to be happening over here with producer prices and CPI inflation and employment, because this is the coincident economic indicators that governments and central banks are committed to hitting. The central bank has a target to hit inflation at 2% and to get maximum employment. So these are the key economic drivers. These are called coincident economic indicators. And basically the leading economic indicators are predicting what's going to show up in the coincident economic indicators over the next 12 months. And then a central bank and a government are going to react to what the leading economic indicators are predicting by using interest rates and other policy to make sure that these coincident economic indicators hit their targets. So if you've got an inflation target of 2% and you want to have maximum employment, the central bank and the government are going to be watching these surveys here to predict what's going to be happening here in the next 12 months. And then over here, they're using interest rates or, for example, taxes, whatever, to affect this area here to hit their target. So there's three main areas when we're looking at economic data, just so you understand what the market will pay close attention to. So when we look at the two main leading economic indicators that the markets always pay very close attention to, we're going to look at manufacturing and services PMI data, because this gives us an expectation what's going to be happening in the manufacturing sector of businesses and services led businesses. And if these two sections of the economy, which make up 100% of the economy, are all predicting growth in their company earnings or employment, for an example, then this is the data that the markets start to really pay attention to get an idea as to whether there's going to be full employment, inflation, and whether that will be leading to higher interest rates. So if, for an example, the companies within the manufacturing sector or the service sector are expecting lower levels of profits, then obviously they may reduce the amount of workers in their businesses to try to save money. This can cause unemployment to rise, and then prices will just go lower because there's less demand for goods and services. So manufacturing makes up 20% of our example in the US economy. The services sector makes up 80% of the US economy. So if you take 100% of the US economy, you've got companies that are selling manufactured goods, or you have companies that are selling services in the economy. So what we need to do is we need to understand what is the data that the markets are looking at that predicts whether manufacturing companies are going to be employing more people, if they're expecting demand for their goods and services to go higher. And if that is the case, then obviously these companies are going to earn more profits, and that's going to lead to them probably jacking up prices because they can increase their prices because of the high demand. And as they have to meet the demand for spending in their economy, they have to employ more people, and as the pool of people available for work decreases, then businesses start to have to offer higher wages to people to fight off competition from other businesses, and it just stokes inflation. Because remember, if all these people are getting drawn into the labor market, if more people are going into work because businesses are seeing demand for their goods and services rising, then obviously as more people get hired, there's less people who are unemployed, then more people in the economy have a job, more people have an income, more people spend money, and that just drives up the demand for goods and services even more. And then you start to get price inflation because businesses can raise their prices because they can, because the demand's there. And also to meet that demand, they have to start to maybe build new factories, hire new workers, train more people, and they might have to pay for that. So they just jack up prices even more on their goods to try to pay for them having to increase their business production to meet that demand. So we look at manufacturing data and services data, but as it makes up 100% of the economy. And what we're looking at is when manufacturing is above the level of 50 in the indicator, that means that the economy is growing. So if it's above 50 and going higher, so if you get prints of 51, 52, 53, this means that companies in the manufacturing sector or the services sector are expecting their earnings, their employment, their business to be expanding, and that creates an environment of inflation. If it's below the level of 50 and contracting, it basically means that businesses in the manufacturing and services sectors are expecting business to go lower and be less profitable, and that's obviously deflationary, and we are going to see a contraction in the economy. And that's not positive. So above 50 and growing is an inflationary environment. A reading below 50 and contracting is a deflationary environment. So in this environment, you'd expect interest rates to be going higher. In this environment, you'll be expecting interest rates to be going lower. So let's have a look at our spreadsheet. So I'm trying to show this in more detail and give you a prime example of the euro area economy, and then what the euro did against the Japanese yen over this 2-year period. So what I want to show you here is this is the manufacturing data in Europe. So between 2016, as you can see here, until 2018, so over this 2-year period, the manufacturing sector in Europe was going through a very strong expansion. So basically all the manufacturing companies were expecting their earnings to be going higher because they was having positive readings of manufacturing above the level of 50, for an example. And as you can see highlighted in red, you have GDP, which is you have the percentage level on the right hand side. And what you can see clearly is as the manufacturing data was getting more and more positive, the economy was going through stronger and stronger levels of GDP growth, right? And remember, if the economy keeps growing, then inflation is increasing in the economy. And then what did we see for the euro? So let's have a look at the euro against the Japanese yen between 2016 to 2018. The currency went up in value against the Japanese yen by nearly 25%, a really strong move. Now this was because, again guys, as inflation expectations were rising in Europe, number one, the stock market starts to go through a high demand because investors are looking at all these companies in the manufacturing sector thinking all these companies are going to go through higher earnings. So they start to buy the euro currency in order to buy stocks in Europe. Because remember, your biofinance, your assets, they're going to be priced in the currency of the country you're purchasing as assets in. So let's have a look. I'm right here at the European stock market. So I can give you a really good example. I can match up the currency and the stock market so you can really understand exactly what I'm talking about. So let's have a look at between 2016 to 2018, European stock market goes up 37%. Again, think about it. All these manufacturing companies that make up the stock market index in Europe, they're expecting their earnings to be going higher because the economic data is telling us that are expecting their earnings to go higher. So investors are looking at European stocks and manufacturing companies going, yep, I want to be buying these companies because I'm expecting their earnings to be going higher. So imagine all these investors all over the world selling their Japanese yen, selling their British pounds, buying euros to go into the European stock market. That means the currency is in higher demand. And at the same time, remember, the markets are looking at the situation thinking, well, Europe's going through higher growth, so inflation is rising, and then the market's expectations for interest rate hikes to start to happen, start to increase. That's why the euro starts to strengthen against the Japanese yen. And then what happens? Between 2018 up until 2020, the manufacturing sector then starts to decline from its peak. So it's still above the level of 50, which indicates growth in the European economy, but the growth starts to tail off and starts to go more and more and more negative. So now investors are looking at the European economy thinking, well, now the central banks are likely not to raise interest rates because growth is going lower. And in that environment, what do we know happens? They're likely to cut interest rates. So now the growth has peaked, and there's no surprise that GDP starts to go lower and lower and lower as the manufacturing is going lower and lower and lower in its reading. And look what happened to the euro over a 2-year period. All that bullish momentum for the euro starts to unwind, and now we see the euro weaken over the next 2 years and go down 20% against the Japanese yen, because now the inflation expectation is going negative, and now we're not likely to get any interest rate hikes in Europe, and now the investors are coming out of the euro and they want to cash in on this previous bullish trade, because now they're noticing that the European economy is not growing at the pace it once was, and the currency then starts to weaken. And what happens? The European stock market over the next 2 years goes up by only 4%. It goes up by only 4%. So if I take this, I switch this around, you'll see how much it went up by. So the stock market went up by, around 4%. So you saw it went up 30% before, and now it's going up only 4% because the manufacturing data was still above the level of 50, but it was not growing. So that means that earnings of these companies are now flat. They're not expecting these companies to go through higher profits. So now no one wants to be buying me European stocks anymore, and therefore it goes nowhere over a 2-year period. And therefore the currency is now in less demand, the euro that is. And now you understand how the stock markets and the currency markets are really linked together based on, again, the manufacturing and the services-led data, because this is what the markets were using to predict what was happening with GDP and inflation, and therefore the currency. And you can see with the services data, it was the same thing from 2016 to 2018. We've seen growth in the services sector, which, remember, makes up a large proportion of the European economy. We're seeing GDP growth going higher, and then after 2018, we start to see that data going lower, the services data starts to decline. And GDP, what does it do? Exactly the same thing. It starts to decline and the currency weakens. So that is a prime example for you guys to understand how the manufacturing and the services data is very, very crucial for us to get an idea what's happening in the companies and the employment situation and inflation. And as one other really important economic indicator, consumer sentiment. And sentiment basically means the confidence of consumers in an economy, because remember, if people are confident about their future economic prospects, they're going to save less, spend more. And what's that going to do? Drive up the inflation, because there's more demand for goods or services, because people are confident to spend the money, because they're confident they're going to have a job next year, or their salaries going to go up. And if consumers are bullish and confident, then that the animal spirits of people in the economy is going to dictate whether the demand for goods and services will rise, which will obviously have an impact on inflation, and that will obviously also have an impact on employment levels. And then we can start to see how the currency gets bought, the stock markets get bought based on the expectations by consumers of what they're doing in their own economy and why they're buying, because they're obviously confident. So what I can show you here is consumer sentiment. This is another economic indicator we look out for. So you can see the consumer sentiment highlighted in blue. And look what you can see highlighted in red is the GDP. And look how they literally move each other. They literally mirror each other, because if consumers are confident, they spend money, and GDP, which is what? Just the value of everything being produced by businesses. The value of businesses start to go up because consumers are spending, because they're confident, and the GDP of an economy is going higher. This is the US economy we're looking at here. And then as the confidence starts to disintegrate, you start to get negative levels of GDP. So you can clearly see, guys, they literally move with each other. And the consumer sentiment is basically telling us what we can expect in the business PMI for manufacturing and services. And therefore, markets are always looking at the manufacturing data, the services data, and the consumer sentiment data to get an idea of how confident are people about their future. So how likely are they to go out in the economy and spend money? Is that going to drive up employment? Is that going to drive up inflation? Is that going to cause the interest rates to be going higher because of inflation? If they all tick yes, then markets start to buy that currency. If they all tick no, so let's say consumer sentiment is getting really poor, and then manufacturing data and services data is becoming negative, and now we're not expecting that many people to be going into employment, we're expecting deflation, then we expect, okay, maybe interest rate cuts are going to be happening to try to stimulate growth, and therefore we know the currency is likely to weaken on that expectation.